Hi,
I'm
Neha and
Terry.
today we'll be discussing comparison between amortization methods.
So what is amortization?
Amortization is the allocation of the cost of a capital asset, such as property, plant, and equipment, to expense over its useful service life in a rational and systematic manner.
Methods for calculating amortization: straight line, declining balance, and units of activity.
Straight line. Under the straight line method, amortization is the same for every year of the asset's useful life, and it is measured solely by the passage of time. Cost minus residual value equals amortizable cost. Amortizable cost divided by useful life in years equals annual amortization expense.
Declining balance method. The declining balance method produces a decreasing annual amortization expense over the asset's useful life. The method has this name because the periodic amortization is based on a declining net book value of the asset, which is also known as cost less accumulated amortization.
Units of activity. Under this method, useful life is expressed as a total unit of activity or production expected from the asset rather than as a time period. This method is ideally suited for factory machinery where production is measured in units of output or machine hours, could be used for assets.
Comparison. So this is a graph showing three different methods: straight line, declining balance, and units of activity. So the red line is showing the straight line method, the blue line is showing the declining balance, and the green one is showing units of activity. So you could see how these methods are different from each other.
Straight line. Amortization results in a constant amount of amortization expense and net income each year.
Declining balance results in a higher amortization expense in the early year and a lower income. This method produces lower amortization expense in later year with the higher income.
Units of activity results. Units of activity results depend on actual usage each year. For each year, the annual amortization expense and net income vary considerably amongst the method. The total amortization expense and net income are the same over the 5 years. Which method is preferable? GAAP requires businesses to match the cost of the capital asset to the revenue produced by that asset. For a capital asset that generates revenue fairly consistently, the straight line method is appropriate. The declining balance method best fits the assets that are more productive, generating greater revenue in the earlier years of their life.
The unit of activity method applies well to assets whose usage varies substantially over time.
So we have an example for you. On January 1st, 2002, Iron Mountain Ski Company purchased a new snow grooming machine for $50,000. The machine is estimated to have a 5-year life with a $2,000 residual value. It is also expected to have a total useful life of 6,000 hours. It was used 1,000 hours during 2002 and 1,200 hours during 2003. How much amortization expense would Iron Mountain Ski record in each of the 2002 and 2003 using each of the following methods of amortization? A. Straight line, B. Double declining, and C. Units of activity. So I'm going to ask you guys to just pause the video and try it on your own.
First, we'll do the straight line method, which is cost minus residual value equals amortizable cost. So you'll take $50,000 minus $2,000 and you'll divide it by 5 years because that's the time, and you'll end up getting $9,600. So secondly, we're going to do double declining balance. First, we're going to find the percentage that will be timing by the cost of the asset. So we'll do it by dividing 100 by 5 years, and we'll get 20%. In 2002, we're going to take $50,000, times it by 20%, and times it by 2, and we'll get $20,000. And in 2003, we'll take $50,000 minus $20,000, times it by 20%, and times it by 2, and we'll get $12,000. Lastly, we'll do units of activity. So we'll take cost of the asset and minus the residual value. So that will be $50,000 minus 2,000, and we'll divide it by the time. So we'll divide it by 6,000 hours, and we'll get $8 per hour. So in 2002, we'll times $1,000 by 8, and we'll get $8,000. And in 2003, we'll times $12,000 by 8, and we'll get $9,600. As you can see, in 2002, straight line method produced $9,600, double declining produced $20,000, and units of activity produced $8,000. And in 2003, straight line produced $9,600, double declining produced $12,000, and units of activity produced $9,600. So as you can see, straight line method stayed same for 2002 and 2003. Double declining balance was 20,000 in 2002, and it decreased over time. So for units of activity, it was 8,000 in 2002, and it increased. So it's going to have more expense in 2003.
The table comparing the three methods will be on the handout that you will be required to be printed out by tomorrow's class. Neha out.
Cherry out.